Hello, everybody. Taxes. I don't know about you, but I have never met the person, including myself, who loves the idea of paying them. Now, we all know there might be some reasons for taxes, but what we're going to be talking about today is 1031 exchanges and how those are relevant with taxes and real estate exchanges, sales, so you can keep more money in your pocket, ideally. My expert guest today is Ryan Vassar. He knows plenty about 1031 exchanges, and there are going to be all kinds of links to his website below where you can learn more as well, in addition to what you're going to learn today in this episode. So hello, Ryan. Thanks for joining me.
Hey, Diane. Thank you so much for having me. I really appreciate the opportunity.
It's a pleasure. Can you start off with, what is a 1031 exchange, and does it apply to all assets?
So what is it? I mean, short answer, it doesn't apply to all assets, but what is a 1031 exchange? It's been a part of the tax code for over 100 years. It hasn't always been named Section 1031, but in some form or another, it's been around for over 100 years. And really, the only asset class that it focuses on is real estate, and specifically investment real estate. So the only thing it really will pertain to is if you have investment property, whether that's a business property or a rental property, but it is a very wide range of investment property because a Airbnb in Florida would be also considered like kind to the Empire State Building, for example. So it's very broad within the category of investment property, but specifically real estate, specifically for investment.
It's interesting. You hit on one of my first questions because I do know a lot of people who are watching this show also have Airbnb properties, either in their homes that they actually live in and then they Airbnb them, or external ones. So it's interesting you mentioned that right off the bat.
Yeah. Yeah, absolutely. And even the ones that are within the home, they can qualify for 1031 as well. You would essentially divvy up the property based on purchase or sale price. And let's say you have a two-family, the first floor is the same footprint as the second floor, you Airbnb one of them. It's basically a 50% allocation to the investment property, 50% to personal use property. So that 50% that you're using on Airbnb or maybe renting out long-term, that would actually qualify for 1031, although it's a part of your primary residence.
Now, what is a 1031 in that? Is it advantageous to someone to take advantage of this if they can?
Yeah, absolutely. And I sort of glossed over the question a little bit, but essentially what it does, it allows the owner of investment property to sell that investment property, not pay any capital gains at the time of that sale, so long as they abide by all of the rules of Section 1031, most importantly being replacing that property with a new investment property of like kind.
Okay, so it's a way to sell on an even basis or step up. Can you go backwards in your investment? So let's say you bought a property, let's just say $500,000. We'll use that, number. Not that you can get too much for $500,000 these days, but I'm just going to use
Not in New York, at least.
We'll go simple math here. So, okay, so $500,000, you have a property, it's an investment property, and you go to sell it. Can a 1031 exchange be applied if you sold it for $400,000 versus $600,000?
Well, it would depend partially on really the numbers that matter are what your sale price ends up being and what your adjusted basis is. So your basis is what you purchased the property for minus depreciation plus improvements. So in that particular situation, if you're selling it for $400,000 when you initially had purchased it for $500,000, you're likely looking at a loss, but if you've owned the property for a long time, you probably haven't because it probably hasn't depreciated down if you've owned it for a long time. But if you've taken enough depreciation where your basis has lowered below whatever your sale price is, then it's potentially advantageous. But it's pretty rare that we see in real estate, especially investment property, that whatever you purchased it for is now you're selling it for less. Normally we're seeing property values increase.
Mm-hmm. And Is there a point in time, like is there pre-prep that someone needs to think of when they think of 1031 exchanges? Like you're an expert in this, you're an attorney, this is what you specialize in. So if someone had, let's say they have a building, let's say they're very fortunate and they have a 12-story building in a place like New York City or a 100-story building, and they are thinking about selling it. And at what point would they reach out to someone like you to say, okay, Ryan, I'm thinking about selling this. What do I need to consider to have the least tax consequence in this mega transaction?
Absolutely. And so right when people are getting prepared to list is a good time to reach out to somebody like myself. Also bringing in their personal CPA, potentially their attorney as well, because there are definitely a lot of pitfalls, a lot of things that you want to make sure are squared away prior to engaging in a 1031, and it's good to have some lead time. That being said, I've been called on the day of closing, and I've set up 1031 exchanges on the same day as closing, and it can be done. But for addressing some of those issues, if there are any, we want to know about them early on so we can direct them to the right people and make sure that we correct those things prior to engaging in the 1031. Because if you aren't abiding by the rules, then it can be disallowed, and then you'll end up paying the taxes anyway, and then you'll have gone through the process for nothing.
Now, when you say these are for investment properties, how do you classify an investment property? Does that mean you can't be living in it? What's the definition of an investment property?
Well, you wouldn't be living in it unless it was a situation like I mentioned before, where you're living in maybe one of the floors and renting out another portion of the house. But the test that the IRS uses is actually sometimes a little bit difficult, because what they use is an intent test. So what was your intent when you had the property? Was your intent to use it for investment? Was your intent to fix and flip it? Was your intent to move into the property? And that's what they're going to look at. They'll look at the facts surrounding that. Interestingly enough, I do a lot of seminars on 1031, teaching attorneys, investors, real estate brokers on the topic. And this is something I talk about. And the example I always use is, if you purchase the property and it's a blank piece of land and you're planning on building a multifamily building on there and then renting it out, then that would qualify for Section 1031, because your intent is to use it for investment. And I recently just had a client reach out last week or earlier this week, and they're in exactly that situation. They haven't finished building the property yet, so they haven't actually rented the property for a single day. There's no income shown on the property, but their intent was to use the property for investment. They received an unsolicited offer from a developer, so it's not like they just put it on the market and were trying to sell it. Completely unsolicited, they came to them and offered them more than what they had paid for it. And the question was, can I 1031 it? The answer is yes, because your intent was to use it for investment. Does that mean that the IRS is going to look at that and automatically say, okay, this is all good? They might ask some questions, they might come and audit, but you have the facts to show, hey, look, here was our business plan to rent it out. Here's the unsolicited email from the developer who offered to buy it. This wasn't the plan in the beginning, but this is what it ended up being. So that intent test really is a facts and circumstances test that's going to be used. Obviously, if there is investment income on the property, then that's a huge green flag. That's great. But there are situations where maybe it's been vacant for the last year. It was rented for 3 years. They couldn't find a tenant, and now there's no recent income on the property. So it's definitely a case-by-case situation. But in general, it's the intent to use it for investment or business purposes.
Now, if someone buys a property and they are buying it for investment or business purposes, are they not buying it in their own name? Are they buying it are they setting up a corporation that is specifically, or an LLC, some kind of format to make that first acquisition? Or is that
not necessarily? There's excuse me, there's a lot of exchangers who own property in their individual name, and sometimes it's just a case of, mom grew up in Queens, mom passed away and gave the property to the daughter, and it went directly into her name, and it's just never been changed into an LLC. Generally, it's advantageous to be in some sort of entity that provides some liability protection, but there are plenty of exchangers and plenty of investment properties that are owned in individual names, not necessarily always in some type of entity.
So, if someone could prove intent, is there any reason, I'm trying to think of how to ask this question, is there any reason someone would not want to, is it to apply for or exercise a 1031 exchange? What would be the word you would use to?
Well, there's no application, but it would essentially be taking advantage of 1031 or doing a 1031 exchange. And yeah, there are definitely reasons why you wouldn't. The main one being if you need cash flow now and you need liquidity, then 1031 might not be right for you because you might want to pay the taxes and, well, not pay the taxes, but you want to take the profits, and you don't want to have to reinvest all of those proceeds into the next property if you need liquidity, if you're looking to invest in something that's not real estate. The other one is some people prefer to not be under the timelines that 1031 has involved, which are very strict.
About those
And
timelines. What does that
exactly. And so you have two timelines to worry about in a 1031 exchange, and both of them start on day 0, which is your closing day. So you close on your sale, two timelines start running. You have 45 days to identify replacement property and 180 days to close on one of the properties that you've identified. So especially in a place like New York, where, Long Island particularly, I'm out on Long Island, it's very difficult because people are buying houses $100,000 over asking price. So putting those properties on your identification, you have no idea if you're going to be able to close on them or not. So you have to act fast. That's one of the drawbacks of 1031. So that might be a reason as well why somebody would be hesitant.
That's very interesting. That's a tight timeline, 45 days. That's a month and a half. Wow.
Yeah, and I do want to sort of note on that is that there's strategies that can be used to ensure a tax deferral if you're flexible and if you're okay with maybe not getting the exact property that you want or ending up in the exact situation. Say you sold a single family Airbnb and you'd like to upgrade into maybe now a 3-family, so it's just all in the same place. It's not managing, different weekend rentals. It's all just long-term rentals, and that's what your plan is. But you're having a really hard time finding a 3-family. Your identification window is starting to close. There are properties out there that are specifically for 1031 investors. They qualify as like kind, and they're essentially a guaranteed closing. So those are things that people can identify as a backup property, just in case their initial plan falls through. They can at least ensure they get the tax deferral by investing in one of these other properties, the most common one being Delaware statutory trusts, which are becoming increasingly popular.
You seem like you have a nice, even-keeled personality. Sounds like you'd have to have that because you're dealing with the emotions of people trying to sell a property, making sure everything closes as it's supposed to close, and at the same time, the clock's ticking to
Yeah, and
that new one.
it's oftentimes where I'm the bearer of bad news because I'm almost a messenger for the IRS sometimes, and I have to remind people that these aren't my rules. These are the rules in place by the IRS, and I'm simply just telling them what they are. So I'm trying to help as best I can. I can't always tell you why the IRS chose to do it exactly the way they did it, but I can do my best to make sure that we're hitting the timelines and give you all of the options so you're aware of things like Delaware statutory trusts as an option.
Now it's interesting because I come more from the public company arena and not the real estate investment arena as an asset. And I'm very familiar with things like SPACs. And a funny thing with the SPAC is you can raise all the money for a SPAC, but you cannot identify the company you want to put in that, acquire for that SPAC until the money's closed. And then the window starts counting.
Yeah.
In a 1031 exchange, if you want to execute one, can you have identified your next property before you sell the one you want to apply the 1031 tax benefit to?
Yeah, so generally we'll call that the relinquished property is the one you're selling, and then the replacement property is obviously the one you're replacing it with. Two things on that. One being, there's nothing stopping you from going out there and looking at properties. There's nothing stopping you from even going under contract on a property. So you can have everything set up. I've had exchanges where, they sell their relinquished property on a Thursday and they close on their replacement on a Friday. There's a lot of moving parts there, and we generally recommend, spread the closings out a little bit just in case something goes wrong on Thursday, you don't get the wire out in time, whatever it might be. But besides the point, so you're absolutely allowed to go under contract on a replacement property. You just want to push that closing date out after you're planning on selling. The other option, which is also relatively common, is what's called a reverse exchange. This is where you have to purchase the replacement property before you're selling the relinquished property. Maybe that's because you started looking a little early and you found a property you love, but the seller's like, I need to close on this right away. And you're like, I haven't even listed my property yet. So if I want this property, I got to do it now. So we also can do what's called the reverse exchange. It's more expensive, it's more complicated, but we can absolutely do it. There's a whole division at IPX that's dedicated just to those reverse exchanges. They are possible, but they're less common. But there are situations where you need them.
It's funny, I'm actually surprised you say they're less common, because you can plan on selling, but there's so many variables as to, getting that buyer, everything being, approved, by whatever has to approve the transaction. And there's just so many variables. And then to be able to close on something or find that target.
Yeah.
I'm surprised you say whatever you call that, the reverse, what was it called?
Reverse exchange.
Yeah, I would think that would be far more common. That's interesting.
So there are businesses, particularly large, like real estate investment trusts, that are constantly doing exchanges, and there are some exchangers that do prefer the reverse exchange for that exact reason. Like I said, the biggest drawback is the cost for the exchanger goes up. So some of them are willing to eat that cost because then they know, okay, we have the replacement already, now all we have to do is sell. A lot easier sometimes to sell than it is to buy, depending on which geographical market you're in. But there are people who do prefer to only do the reverse exchanges for that reason you mentioned.
Is there a property, trying to think of the word you would use, asset size, or a threshold of a price that is the minimum threshold for a 1031 and even possibly a maximum?
No, so especially throughout the country, obviously property values vary drastically. Even we see it just in New York. I've had exchanges as small as the relinquished selling for $115,000. Especially when you start going upstate. It was a property that was purchased for $20,000 that was now being sold for about $120,000. So there's still a sizable capital gain there that they wanted to defer. On the flip side of things, like I said, you have those real estate investment trusts, you have hotel chains and large companies that are doing exchanges with office buildings and portfolios of property, so you can start creeping into the hundreds of millions of dollars as well. The average exchange in the country is around $1 million, so it's definitely a lot of mom and pops, it's a lot of smaller landlords, but there are certainly those huge exchanges as well. New York is slightly skewed a little higher. We're going to see a little bit of a higher average for an exchange because a studio in Manhattan can cost $850,000. So it's a little bit higher in New York, but like I said, there are certainly those upstate properties that sell for much less, but it doesn't really matter what they're selling for. The whole thing is, what's the difference between what you bought it for and what you're selling it for now? Because even a $50,000 gain, somebody still might want to defer that, $18,000 or so in taxes.
Yeah, it's funny you mentioned, New York always skews everything when you're looking at, the rest of the country. You look at the prices here, it gets confusing when you're trying to find a mean or an average. So, question for you. At what point would someone, let's say they had a property, they want to sell it, and then they say, well, I had this property, I could have been renting it, I didn't rent it, but I could say I had intended to. At what point can somebody call you up and say, Ryan, I want to do this, without triggering every red flag on the IRS planet?
Well, the first red flag is going to be if there is no income on the property, that's a red flag, and that could trigger an audit. Once there's an audit is when they're going to look at, well, did you even list it on StreetEasy or Zillow, or were you actively trying to find a renter? I've seen cases where it's in an HOA of some kind, and they might look at the HOA agreement. The HOA says, we don't allow rental properties in this HOA. The IRS is going to automatically say, okay, well, you can't say you intended to rent it because it was against the rules. So that's sort of what I mean by it is very much a totality of the circumstances. And they're going to look at your personal use of the property. Were you using it? Were you letting friends use it? Like I said, the no income being reported is probably the biggest trigger for the IRS or the New York State Tax Board to say, hey, we want to take a second look at this. And then you better be prepared, like I mentioned in the situation with the developer or the purchase by the developer, who has good facts to support her case to say, hey, look, this was the plan. Here's the unsolicited offer. It just sort of happened this way. They have a pretty good set of facts, whereas if it's just maybe a vacation home or a second home that you don't really use, but you also don't really rent out, you might have to work a little bit harder to show intent that you were using it as investment property.
Now, as a 1031 specialist, and that's your focus on law, and are you does that count as are you a tax attorney? Like, a state attorney? Like, where do you fit in the attorney landscape in someone who's going to file their taxes?
Yeah, so I'm a little bit of like a very niche and outlier in the world of attorneys. I'm not really a traditional attorney. My background is in real estate law. I also did some litigation, but I was more so on the transactional side of things. Now, the actual title and role is qualified intermediary, which is an interesting position because, first of all, you don't have to be an attorney in order to do it. It certainly helps to sort of parse through the tax code and the rules and regulations around it. But also, one of the things that most of us, I think, in the industry struggle with, particularly the attorneys, are that you have to act as a neutral third party in the exchange. So we're acting as the neutral third party. I always tell people I can tell you what the rules are. I can't necessarily then go and give you my tax or legal advice. I'm happy to talk to advisors, so talk to their CPAs, talk to their attorneys about what the rules are, and we can, try to figure out what is best for that particular person, but I cannot give tax or legal advice.
Oh, that's a very interesting position to be in, because it kind of reminds me of my day job, which when I'm not podcasting, I'm advising clients, and I tell them, listen, I am your advisor. You're hiring me to work with you and give you my best advice. But my best advice is going to be looking at everything and all perspectives and all the perceptions involved, which might get you very upset as I relay them to you.
Yeah.
But that's how I'm being your best advisor, to say, well, you think this deal is fantastic. You're going to have these three other stakeholders that are going to be not so happy.
Yeah.
Yeah.
No, absolutely. And we often deal with the partnership issues as well, where two people own a property, they're not on the same page, and you start to dip into the world of like therapy and psychiatry. And I'm like, I do want the exchange to go properly. I want it to go well, but there is certainly always a line that I have to draw in saying that, I have to remain neutral in this. So here are the facts, here are the rules, and do with that what you will.
It's very interesting. And you said you do, well, you have this legal background, which is no doubt a mega asset. Someone does not need to be an attorney to be this neutral party. So it's kind of like being, going through the courses to become a mediator.
So actually, one of the interesting but also frightening parts of this industry, and I can get into why, is that the qualified intermediary position is not regulated in any sense. So anybody could be a qualified intermediary. The only thing that disqualifies somebody is if you are an agent of the exchanger. And by that, I mean you're their attorney, you're their CPA, you're their real estate broker. You can't be actively working for them or providing them with a service in the previous 2 years. That makes you a disqualified party. So now they're in this weird situation where they have a CPA they trust, they have a real estate broker they trust, they might have an attorney they trust, but none of them can be the qualified intermediary, so they have to get this neutral third party. That's where we come in. But anybody could do it. So there's nothing really helping that person vet.
But that doesn't mean you want anyone to do it.
Exactly. And the reason, particularly why it can be so frightening for somebody, is that we're taking receipt of the funds when they sell their relinquished property. They can't touch the funds. According to the IRS, they cannot have receipt of the funds after they close. So the property closes and the money goes into an escrow account that we've set up for them. And then when they're ready to purchase a replacement property, we're sending the money out and we're purchasing the property, the deed's going directly to them. So we might be holding up to $5 million of theirs for that 6-month period, that 180-day exchange window. And they may have just heard about IPX or heard about Ryan Vassar the week before. So we try to set ourselves apart by, first of all, being the biggest qualified intermediary in the country, but also we're a subsidiary of Fidelity National Financial. So we're publicly traded, we're associated with Fidelity Title and Chicago Title, and we're on the Forbes 500 list. So we do have a certain amount of internal regulation, but there's nothing stopping the barber down the street from calling himself a qualified intermediary, taking receipt of those funds, investing them however they see fit, and then hoping the money's still there when they're ready to buy replacement property. So it's a frightening decision for people.
Well, if you ever need someone to tell you what can happen when you put your escrow money in the wrong hands, I can tell you about that house builder I met in Pennsylvania back in about 1984 or 85, and I gave him the money. He was in his trailer. I gave him my $8,000, which at the time was the world to me because it was going to be my second home out of New York City. Mm-hmm. And I came back, and he was going to build my A-frame home on the lake. And I came back like a month later to check out how everything was going, and the trailer wasn't there, the property, no signs of the property were there. And the police were like, oh boy, this happens a couple of times a week. Sorry, we don't know how to track this person.
Yeah, it's unfortunate, and it's happened before in the qualified intermediary realm because of the lack of regulation, and it's very recently, not so much, but 2008, 2010, there were some cases where qualified intermediaries ran off with the money. So it definitely happens, and we see all the time wire fraud attempts and constantly getting, phishing emails and notifications from IT, watch out for this, watch out for that, different IT trainings. So it's definitely very prevalent, and it's scary.
Now, is a qualified intermediary got to have or really good to have?
So you absolutely must have a qualified intermediary for an exchange because somebody has to take receipt of the funds at closing. If the exchanger takes it into their account, they've actually received the funds and they've disqualified themselves. They owe the taxes at that point. If I get the call that says my attorney's holding the funds, we just closed 2 days ago, they've constructively received the funds. The IRS basically says the attorney is an agent of yours. You have control over the attorney has control over the funds. So in essence, you've received the funds. So a qualified intermediary has to be involved prior to closing if you want to do a 1031 exchange.
That's a good business model, but you must be present.
Yes, the IRS requires it.
I went the wrong way in my career. No, I actually, those kind of businesses are great. That I owned an investor relations firm for 25 years, and it was great because every company kind of needed one.
Yeah, exactly.
Very interesting. What have I missed in this episode, Ryan? I know there's tons because you're a wealth of knowledge, but if we want to make sure somebody knows, they want, obviously the big one, the big thing, everybody, is you want to call Ryan. Don't just try to think you can do a 1031. Don't just count on your attorney. Call Ryan, get some good advice, bring him and his team in. But what else did I miss, Ryan?
I would say one of the biggest misconceptions in the area of 1031 is people don't realize that the number that really matters at the end of the day is what did you sell the property for? If you want a full tax deferral, then you have to replace the entire value of that property, meaning you sell for $1 million, you want to buy for $1 million or more. A lot of the times people will think, I sold for $1 million, but only 300,000 of that is capital gain. So I want to take the 700,000 out and just reinvest the 300,000. And that doesn't work. So that's an area where I have to sort of correct people quite often. And then the other area and the other question I get a lot of the times is, well, why am I going to do a 1031 if it's just a tax deferral and eventually I'm going to owe the taxes? And there is a whole host of different reasons, which would take too long to get into, so I'm not going to get into all of them. But there's a whole bunch of different reasons. Just for example, being if you want to sell your property in New York because maybe it's become increasingly difficult to be a landlord in New York and you want to move your property to somewhere that's a little bit more landlord friendly, then you can use 1031 to move those investments around. You can use 1031 to go into larger properties and grow your portfolio. So there's a whole host of reasons for why people would want to do a 1031, even though it's just a deferral mechanism and not a complete tax elimination.
Mm-hmm. You said one thing that triggered. I'm 65, and if there are benefits to being 65, one is that I'm still standing. That's my number one benefit. And then there's all kinds of tax things that are being looked at. If someone was doing a 1031 and they're in that older area, like me, or older, are there any benefits for selling that property? Or is that just exclusively because you're 65 and it's a private property versus a 1031 exchange?
Well, if they own investment property and they're older, a lot of the times we're starting to think about the estate. We're starting to think about turning that tax deferral into a tax elimination, because the only way to truly do that is through death and getting a stepped up basis for your heirs. Mm-hmm. So if you continue to 1031 throughout your lifetime, and now after 5, 6, 7 1031s, you own a big 12-story building in Manhattan, you might want to sell that just so you don't have to manage the 12-story building anymore or have to worry about it. Maybe go into one of those management-free Delaware statutory trusts I mentioned earlier. And that way you're still invested, you've continued to 1031, defer your taxes. When you do pass away, your heirs are going to inherit those Delaware statutory trusts at an increased cost basis, and they're not going to pay taxes at that point. So we can turn a deferral to an elimination if we're using it in estate planning.
Wow, you're a treasure. You're a wealth of knowledge, Ryan. I really learned a lot during this, and I enjoyed every minute of it.
Good. I really enjoy it, so it's easy for me to talk about, and it's a very interesting topic, and I love that I just focus on this one area now. It's so interesting to me, so I really enjoy it.
Well, I can tell, and anyone watching this can tell too. Hi, everybody. I've been speaking with Ryan Vassar. There are going to be all kinds of links to him, so you can find any info about him. I highly suggest you check out his website. There's tons of info there. I was enjoying looking through it prior to this episode. And reach out if you need him. And I think one of the big messages here was reach out and probably consult with him before you think you need him, because that would be pretty wise if you have a property, if you're thinking about tax planning, looking into the direction of these 1031s and want to protect your money, which is always a good thing to do.
Yeah,
So
absolutely. And I don't bill on an hourly basis anymore like a traditional attorney. So that's good. Free phone calls.
there you go. Okay. Okay, everybody. I'm Dian Griesel. This has been the Silver Disobedience Perception Dynamics podcast. I encourage you all to hit subscribe, share this with your friends, share this with everyone you know who's a property owner, an attorney, someone who's advising estates. They're all people who would want to absolutely know about this episode. So thanks for tuning in, everyone. Thank you, Ryan. Ryan and I are moving over to the green room. Take care. I will see you soon, everybody.
Thanks, Diane.
Thanks, Ryan. Hit subscribe.